Okay, I saw so many people are joining this session today. I'm so glad. So hopefully we will bring some valuable insights to you from our precious guests, Peter and Asim. And if you have any questions, feel free to ask in the Q&A sections, and we try to answer as many questions as possible. And I think now it's time to start. So welcome everybody. My name is Yasi. I'm the co-chair of Crypto Value Association Startup Working Group. And today our topic is the landscape of fundraising for blockchain companies. And I'm so honored to have two guests with me, Peter and Asim. So Peter, his full name is Peter Saddington, and he is founder of StaaS Fund. And StaaS Fund is a strategic growth fund for cryptocurrency mining platforms and DeFi Web3. And he's a serial entrepreneur. He founded this 10 million venture capital to invest in blockchain and IoT. And he also published 3 books, completed 3 degrees, and trained thousands of people in Agile and Scrum as a certified Scrum trainer. And he's also a race car driver and a go-kart dad. Together with Peter, I have Asim with me, Asim Ahmad. He is a co-founder, a partner at Eterna Capital. So Asim is a very experienced person in the investment world, and Eterna Capital is a London-based investment management firm investing in early stage companies using blockchain technology to disrupt existing business models. So Asim has over 10 years experience in the investment industry and is a CFA charter holder. And Eterna Capital was formed in 2018 and has established itself as a leading firm with a successful track record and institutional grade solutions. And they have invested in many successful projects like Algorand, Dfinity, Kraken, Hedera, Hashgraph, Origin, and many more. So today is a perfect opportunity for you guys, for startup founders here in Startup Working Group, to ask questions to our 2 VC guests. Okay, let's kickstart. So Peter and Asim, is there anything you want to add to my introduction?
Oh, I think I'm good. Thanks so much. It's always great to help out, Yasi.
Same, Yasi. That was perfect. Thank you.
Yeah. Okay, great. Then I'll start with the first question. Looking back on 2022, so what is your opinion on the fundraising landscape in the blockchain industry? Is it better? Is it worse? Or what type of companies get more traction? Just what is your general overview and experience?
Well, I can jump right in. I can tell you that the 2022, so we're looking back just last year, the market was a little bit tough because of the overall digital currency market in a whole. Since we were going through a bear market, we had a lot of dry powder and a lot of venture capitalists that were kind of sitting on the sidelines wondering, should we be investing? Should we be investing during a bear market? Well, for me specifically, I feel like it is always a good time, especially in a bear market. So for our venture fund, and I'll just speak specifically about us, our venture fund, we invested in over 20 projects in 2022. And so we believe that some of the best builders and some of the best operators out there are building during a bear market. And the reason is because there's not as much hype going on. We don't have to focus so much on the mainstream media and the hype cycles of big price action, but rather we can get down, get dirty, put our heads down and build. And so while many of the mainstream venture capital allocators out there were kind of holding their capital off to the side and kind of benching their capital, we specifically deployed a lot in 2022. So I think it really depends on the particular thesis and the strategy of a venture fund, and especially if you're looking into deep Web3 opportunities. So I think it really depends.
And
yeah,
you
so,
mentioned, oh, sorry,
from my perspective. So it's basically we didn't slow down. We're euro denominated, so it's not like we were holding everything in crypto and we had less to deploy like some funds maybe did. We probably deployed in around 10-15 last year. We always look at the opportunity itself. The valuation is something which you look at in the context of market. and also the raise, but an opportunity is either good or bad, and we take it through our usual due diligence from that perspective. But what happened, I know a lot of VCs were looking to see who the I wouldn't say the winners and losers, it was mainly just losers really. So they were trying to see which markets get destroyed. And there's certain industries which took more of a hit than others, you could say, like NFTs, and maybe some of the others took a lot more of a hit than perhaps some of the more infrastructure businesses. I think talking a bit more about trends, companies were told to focus a bit more. The ones who had raised were told to focus more on generating revenue, finding product market fit, rather than growth. It was because you continue to spend. Those funding rounds need to be pushed out a bit further. Runways need to last a bit longer. So it was a case of founders. I'm sure the entrepreneurs out there already know that entrepreneurs need to sweat, and you really do need to, not just because you need to run a tight ship, but it's also how you run an efficient business. And I think some of the larger companies, which perhaps swelled up with a lot of fun and money, also ended up having a lot of costs. And these companies in a bear market where revenue dried up or what product market fit was never achieved are the ones where there was a lot of struggle, and they're not always small companies. And I think that trend has flowed into this year to the point where even right now we're seeing more funding go towards pre-seed and seed stage deals versus Series A, Series B, for the reasons I mentioned, such as, larger rounds require larger allocations from VCs. They also are companies which have a higher cost base and maybe not so much to show for it. But backing something pre-seed, seed with less money, possibly giving the company like 18-month runway, is something which VCs find quite attractive right now. I think that will start changing as the market picks up. The bigger, the further stage companies will start generating revenue and start being able to show those longer runways as well.
And both of you guys mentioned that in the last year you invested in, like your fund invested in 20 or around 15 different projects. Can you share with us why do you decide to invest in those kind of projects? That where are they located? What kind of, in which segment among this industry that they're operating, and what is so special about them?
Well, I'll jump in first here. We invest specifically in one particular thesis, which is continuous yield. And that's something that our hypothesis and our investors and LPs really appreciate. And so if you think about anything that's continuous yield, it's always going to be either in the staking world, the DeFi world, or the yield platform world. And what's great about this is that during the bear market, there's such a focus on getting things operationally tight, lowering your risk exposure, lowering your OpEx or CapEx. You don't need to be doing a lot of marketing, right? You can lower your Google ads and these types of things because there's not a whole lot of money to be spent on this runway and on these operators. And so what's great about our particular thesis is we only invest into companies that are creating yield platforms in the DeFi and Web3 space so that they're constantly creating yield or generating yield during the bear market. Many of our investments are global, so they're all over the world. I think we've covered about five countries, 5 continents, I guess, or 5 countries globally. So there's great operators all over the world that are building in the DeFi and the yield platforms. And these are the areas that we're looking at. And because it has not only multiple revenue streams, but they're constantly generating yield. And this is something that's really, really powerful as we move more into the Web3 space.
Okay, I think Asim, for Eterna Capital, maybe you guys have a different strategy or direction. Can you share with us what is your approach?
Yeah, so I think to give you a few examples, we invested in a DAO tooling company based in the UK. The majority of our investments are in the US. So this company was already generating revenue. I think, it's good to see certain things like product market fit, 18-month runway already, those types of things. Another company, it's called Space and Time, which is a decentralized data warehousing solution. The round was led by Microsoft Ventures. We joined that round as well. There's a couple of others. There's one recently, which is in the cybersecurity space, which is basically it's going through the A16Z accelerator program. I think Kraken Ventures are also joining us on this round. This is one I don't think it's actually been announced, but they probably announced it this week. So again, US based. I think what we find generally is, even though we're UK based, and around 80% of our deal flow comes from the US, just because of the VCs we're connected with. It's a global economy now. These people who want to grow through network effect, they can't just be good in US, they need to be good globally, and we help with the Europe side of things. So it doesn't necessarily mean because we're here, we focus just here. And I think that's something that startups need to know as well. It depends what you're doing, really. But if you're building a bank in Europe, you don't really need to care too much about what someone's doing in the US unless they're coming over. But if you're building like a protocol or something, you're competing globally. So we look at the opportunities at a global level with that respect as well. But we don't generally, have a specific focus to say US. We just find better deal flow and high quality there. And generally, I'd say, it's a case of good opportunities will always show up, whether it's a bear or bull market. So the good founders should always be encouraged to push on. And that's why we want to continue to deploy in such market conditions, because it doesn't mean the opportunities really go away if you're looking for the top quartile.
And would the valuation for good quality project be lower in such market condition, or it might not be so because there will be other VCs competing to invest in this high quality project?
It can vary. It can vary quite. It really is. I wish it was a bit like, the public markets where everything takes a hit together, everything goes up together. But it's hard to find like a market beta. It's really, it's a bit of, it's really a case of how much interest there is in a project, and it's a negotiation. And as a VC, we just need to look at it from a perspective of how much value, how big we think they can be within their target market, and what kind of return it can achieve for us. And of course, we want to ensure the team remains incentivized while at the same time not being ripped off. So it is a bit of a balancing act, but there's no one size fits all. But in it, talking more generally, yes, people have recognized that, from a fundamentals perspective, your forecasts of revenue have to, become a bit more conservative, just because of the market. Otherwise, no one's going to believe you or believe you know what you're doing. And from that, and that's going to reflect in your valuation in most cases. So you do tend to see it go down. But sometimes when you're talking about some high profile deals, then you don't really see as much of a discount as perhaps the rest of the market.
I think in most cases, you're going to see valuation. I agree with Asim completely. I think it really is dependent. But what I've been finding is that overall valuations have gone down because there's not as much investment capital that people want to deploy. Number one, they're risk averse because of the bear market conditions. That number two. And number three, let's be honest, digital currency as of recent has taken a big couple hits in the kidney and the face with a lot of these FTX, Celsius, Luna. So there's a lot of dry powder that's sitting on the sidelines because they don't know where digital currency is going. Now, if we move into 2023, obviously one of the biggest areas is AI, right? With ChatGPT and these types of things. So valuations in that particular arena are going to be exceptionally high because of the FOMO, the interest, the intrigue, and as well the momentum and mainstream media appeal. So if you're doing really great diligence and looking according to your thesis, whether it's in DeFi or staking or it's in platforming or what have you, you're really going to have to look at the operators themselves. I'm going to repeat just what Asim said. Do they have good economics, right? Are they looking long term? Are they not spending too much in the wrong areas, right? Are they creating the right amount of runway? This is what we're looking for in great operators during a bear market. Do they have the grit? Do they have the perseverance? And are they going to go real skinny during this bear market so that they can come out on the other side as a survivor?
Right. When you talk about the last sentence, it's very interesting. Will they come out as a survival during this time, after this time? Would you think for startup founders, maybe it's better that they preserve what they have, prolong the runway, and then when the market condition becomes better, and then they start the fundraising exercise? Would you think, or they should start as soon as possible just to get as much as money as possible so that they can extend their runway with the current operations level?
I think it would be easy for both Asim and I to be able to say it depends, but during a bear market, you're not going to find as many opportunities from two perspectives. You're not going to find as much money from venture capitalists, private equity, high net worth individuals, institutions, number one. You're not going to find as much during a bear market because they're waiting to figure out whether what the outcome of this bear market is going to be. And number two, when it comes to digital currency and the cryptocurrency and Bitcoin space, there's less interest and intrigue and engagement overall from the retail sector. So if you're building a platform for retail individuals or customers that are in the retail world, they don't have as much money to spend either during a bear market. And so spending money as an operator or entrepreneur on ads or community engagement or these types of things is probably not the best place to spend money. What it really needs to be, and this is something that Asim has brought up a couple of times here already, is product market fit. Are you building the right functions? Are you building the right features? Are you ensuring that all your time and engineering capacity is going to building the best polished functions and features that have the highest amount of value to your customers? And hopefully you have some semblance of a community. You have some semblance of a feedback loop with individuals and entities that can give you feedback on whether your features and functions are good. Are they valuable? But right now, you really want to be conservative with your spend because we don't know how long this bear market's going to last. And we want to make sure that our investments, especially as capital allocators, that our investment into the operators is going to be worth the time.
Yeah, I think if someone's got money waiting to come in, sometimes you have to be opportunistic and take it in. But if you're talking about the general view, then just like Peter said, if you're talking generally and you're going to start fundraising for now, then you really need to look at your roadmap and think to yourself, okay, if I get product market fit, then that could be a good time to raise capital. One, because it massively increases your chances, and two, you'll have to give away less equity because your valuation will have gone up because you've managed to achieve another obstacle and raise at a different stage in your business.
Right. So talking about product market fit, I'm very interested in this topic because through my personal experience working with different startups, and how do you guys as VCs to evaluate the product market fit, since there are so many new technologies, new solutions coming out to the market that might never exist in the past, so it's completely new. So what are the indicators to show for startups, like to show to you guys, like, hey, I achieved product market fit, or there's a chance that my product fits into what the users need?
Peter, do you want to go or do you want me to go first?
You can go first. I'm just taking notes.
Okay, well, I think, Yasi, product market fit is either achieved or not. If you say that this is where I think my product fits, then it's not been achieved. So I think it is really binary. Either you've done it and then the proof should be evident based on what kind of business you have. You'd have clients, right? You'd be post revenue.
Like what kind of proofs, for example?
Well, yeah, a client or post revenue, I think, is the proof of product market fit. You've got someone who's willing to pay for what you built. If you're at the point where you're saying, I think this person will buy, then it's not been proven yet. And you will need to build to get there. Of course, sometimes you need funding to build to get there. Yeah. So that's where it's a case of, can you get funding? Can you bootstrap? And that's one of those. That's basically what entrepreneurs need to sweat about.
The chicken egg problem.
That's the sweat part, right? Otherwise it's just just like being an employee and having an easy life. But if you want to be an entrepreneur, I think that those are some of the challenges you need to to overcome. And I think, as a VC, whether it's pre-product market fit or post-product market fit, we have to believe that the team who's in charge, from a tech perspective, can build what they are saying, but then also from a business perspective whether they have the team now or will be able to hire the right team to basically to actually grow the business once the tech is in place. So when, we have to look at the team to ensure that they can actually execute on the roadmap. It's all good having a roadmap, but is your team able to actually achieve the roadmap? It might be achievable, by anybody, by certain people in the world, but is your team able to achieve what you've set out? Or is it just, just going to be milestone after milestone missed? So these are some of the things we would assess when looking at it. And of course, if you achieve product market fit, you're basically showing people you can achieve your milestones. And that's where it gives people conviction. It all often comes back down to the team, and conviction in team grows when the team has more to show.
Absolutely. If I'm ever, I echo Asim's comments here. If I'm ever approached by an operator or entrepreneur that says, we found product market fit, you probably haven't. Product market fit is something that is binary. You either have it or you don't. Now, how do we know this? Well, you can validate it through customer trajectory, right? CAC, customer acquisition costs are going down. You have revenue. You have a trajectory that is growing at some level. I always like to use a systems thinker, Edwards Deming. Some of you guys have probably heard about this guy, but Edwards Deming had a great quote. It goes like this: "In God we trust, everyone else bring data." I need data, right? If you are hitting product market fit, show me the data. Show me your trajectory of growth. Show me the community, the users, the customers that are giving you feedback, that are appreciating and or paying for the product or service that you currently offer. Are you iterating on it? Are you inspecting and adapting? Are you improving it? Do you have feedback loops that I can see engaged with your customers or community that shows that, yes, you are appealing to them, number one, you're iterating and improving the product or feature, number two, and number three, most importantly, do you have the data to back it up? So once again, in God I trust, everybody else has to bring data.
I love this sentence. I'm going to, probably you already tweeted, but I'm going to retweet it. So I have a follow-up question based on what you guys talk about. If this startup can prove product market fit, and also what are the other things that they can bring to the table? For example, the revenue shows that, and the roadmap achieved. What about the team? So those are some kind of factors that you use to evaluate a startup, right? What are the other factors you also look into to make your judgment for investment?
Sure. Team. We look at the technology. We look at the market, business development side of things in terms of go-to-market strategy. We will look at the industry and market size that you're looking to go into to see if it's a large enough opportunity for the type of growth you're looking for, and also for us to get involved. We also like to look at where we can get involved and if we can help to make sure that it's a good fit, and also if they can operate in a way that we can work with them. Because, as a VC, we have objectives because we're managing other people's money. So we have our own fiduciary duties. So we need to ensure that we can work with people in a way that, because as a VC, you can have a, you can find, like, you don't need many 50x's. You just need your 50x, right? You don't need every single one in the market. You don't need to look at everything and say, oh, I missed this, I missed that. You just need yours. So we don't necessarily have to work with everyone, and we can be selective. So it's a case of making sure it's a good fit. We also like to see teams who, this comes a bit back to the team, but saying a good team, people, entrepreneurs might look at it and say, I have a good team. You need to have a good network to basically be able to fundraise and to be able to get clients, because especially if we invest in a pre-seed or seed stage deal where it's going to be your smallest round of funding, we need to be able to believe that you have what it takes to raise subsequent rounds and larger funding rounds in the future. Relying on us to, just do that first stage for you. And then, you raise a 5 times larger round, 2 years from now. And then you're looking at us to say, you do that for us. That's not how it should work. So, there's many aspects if we wanted to grind into what is a good team beyond just having a good idea and being able to build good technology.
I will absolutely agree here, but I'll take it a level deeper. For us, the team is absolutely essential. But at the end of the day, the number one reason why any entrepreneur fails is when the core operator quits. And that's super important. When the founder, not the co-founders, when the core founder quits, that's when the startup is dead. And so a big part of our interview process before we cut a seed check and an early stage check is, does this individual have two P's? Do they have persistence and do they have perseverance, right? We need to meet that out. And so for me, I like to tell this to our LPs is we invest in more 47-year-olds than 22-year-olds. The reason is very simple. 47-year-olds have decades of experience in this particular market segment. They've grown some expertise. And if we look at it statistically, 47-year-olds have a higher chance of succeeding in their market and in their startup because they have the historicity, they have the experience, they have the knowledge, and they have the know-how. Now, it's great to invest in a unicorn 19-year-old startup entrepreneur that ends up being the next Mark Zuckerberg. I've never met that guy. Most of our successful investments are in 36-year-olds to 50-year-olds. And the reason is exactly what I just said. They have the experience, they have the knowledge, they have the know-how, and they have persisted and persevered in this market for a good long time. Let's get back to your question though, Yasi. You asked about what are some of the other metrics that you're looking at for product market fit and viability of this investment. One of the things that we focus heavily on, since we're in the Web3 space, is community. Are they engaging with the community? Are they creating community? Are they creating feedback loops with individuals, entities, or influencers in that community that can help them grow, not only from a grassroots perspective, but grow from a feedback and improvement perspective? One of the things that I ask operators early on before we cut a check is, tell me about your top 3 influencers in your community. I'd like to interview them. If they don't have 3 influencers in the community that they can bring to me so I can ask them questions, hey, what do you like about this guy? What do you like about this product? What do you like about this community? If you don't have that, it's going to be really hard for me to validate that you have product market fit, because ain't nobody buying your product. Ain't nobody talking and socializing about your product. There's nobody championing your product outside yourself. And so since we are now in this Web3 world, which is solely focused in so many ways on community, right? Because Bitcoin started Web3 and it was a digitally native asset. It was grown by the fringe of society, grown by internet communities, right? Since we're in this world now, it is absolutely part and parcel that every operator out there, at least within our thesis, has a community that they're engaging with, and they have influencers and or people in that community that are leaders that can tell us more about what that operator is doing and how that community is receiving it. And so this is one of those aesthetic nuances that we look into that I think is super important, because the community ends up being an extension of your marketing, and in many cases, it's free.
Right. And the word of mouth marketing actually is the most powerful one.
You got it.
Yeah. We have a question from the audience. The question is this true? Okay. Growth PE investors care about other things than gross margins, which in isolation are meaningless. So number 1, profitability matrix, which eventually translate into FCF generation, normalized EBITDA, CapEx, EBIT, contribution margin. Number 2, how a business can defend this, for example, IP, scale/cost position, brand stickiness, especially if profitability is above a typical industry level. Number 3, economics of growth.
I can answer that Relatively quickly, Benedict Orban, thanks for the question. The context of your question is growth PE investors. So growth private equity investors are very different in their thesis and capital allocation than a venture capitalist, traditional venture capitalist, right? A traditional VC, especially when it comes to early stage and seed, we're okay with the ephemeral idea that you think you thought you have and the product market fit that you think you're going to get, right? That is the risk that we're able to take on your idea. Whereas a general traditional private equity investor already has a substantiated industry that they're good at, they know a lot about, they're trying to help you get optimized and get to a point of profitability so either they can flip it or grow to the next liquidity moment, right? And so when you ask the question, do they care about things other than gross margins, which in isolation are meaningless? They actually care about all these things. That's not to say that traditional VCs, early stage VCs, don't care about this as well. But in many cases, in early stage investments, we don't have EBITDAs, we don't have CapEx and contribution margins, and we don't have IPs, or we're trying to moat some sort of intellectual property, right? And so in many cases, it's apples and oranges. But I would say that as a growth private equity investor, you're obviously going to care about normalized EBITDA, IP scale, cost position, brand stickiness, and economies of growth, as well as unit economics. Those are things that you're going to have to care about if you're in the PE world.
Yeah, not really much more to add. Yeah, these are not metrics you look at in venture. If someone put them into a 5-year financial model, it's really just garbage in, garbage out at that stage, because it's too early to really, to even decipher any of that. But defensibility of a business model is important, because VC works is probably the fastest pace industry where people will always catch up. There's probably several people doing something similar to you. So defensibility of your business model, having some kind of cutting edge, some IP, and looking at the economics of growth, of what's driving growth for you. It's all, you could say, more storytelling rather than substance at this stage versus the PE stage.
Agreed.
Okay. And the other question is related to when is the best time to raise funds? Is there some seasonal to it in terms of which month of the year, or bull market, bear market?
Well, I'll put it this way. It is far easier, as we have seen, to raise money in a bull market because money is sloshing around. Everybody wants those big gains, right? There's enough narratives and stories from the mainstream media of these big epic unicorns that are getting overly funded, and they're in many cases over leveraged, as we find out later, which is why they fail. But it is far easier to raise money in a bull market because funds are sloshing around money, right? Everybody's winning. Everybody's feeling high and mighty because it's in many cases, and I'm sure Asim can agree with this, in many cases, as we've seen from examples of FTX, which has kind of opened up the hood, is that many investors don't do the diligence during the bull market, right? They don't look under the hood and they're just momentum investing, which hand raised, like I'm guilty of it. Like momentum investing is easy, right? A16 invested, we get an opportunity to be on the cap table. I'm going to do it too, right? They probably have done their diligence. So it's far easier to raise in a bull market than a bear market. However, in my experience, it's the bear market investments that are truly the operators that are really trying to figure out how can they make product market fit? How can they ensure that they're getting to a revenue stream or getting to a profitability that actually makes sense? And there's less of the storytelling and there's less of the shenanigans and actual real functions, features that provide value to customers.
Yeah, I'd say, there's so much more money in the bull market. There's, even individual investors or, hedge funds, VCs, everybody's got more money. And there's a lot more venture funds as well. Now we've got less venture funds, and even those that are here, I'd say, there was a point where people stopped around FTX. Maybe for most, it was just a couple of weeks. For some, it was a couple of months, just to understand what the losers will be, understand the shakeout and the impact on existing portfolio companies before looking at new portfolio companies. But generally, whoever's around, I'd say take some, you should take some comfort in the fact that even in a bear market, the VCs who are here, they're only here because they believe in the long term of the industry. Otherwise, they shouldn't. Well, they wouldn't be. We wouldn't be investing in blockchain full time, dedicating our full work life to this if we didn't think that it's going to be another cycle and another cycle, and this is going to turn into something big. So, you know, definitely take stock in that. And, you know, I think the question shouldn't always be about how much you're going to, you know, when's the best time to raise. It should be also be about how will I be most successful? And I think because you raise to be successful, you don't raise for the sake of raising. It's all about business success. And I think the best successes are those that come out of the bear market, where only the serious people are doing it. There's a lot more focus on building. And when things pick up, you're in the right spot ready. If you had, you know, raised in the last cycle, maybe you'd have enough money to last till the next one. But really, you know, if we focus more on success rather than raising, then if you do, you know, if you manage to build now during this bear market, whether you raise to build or you just build in another way by bootstrapping or any other way, or partnering with other people, that's going to be, I think we're in a very good place. I'm very optimistic about the stuff I'm seeing. And I think, you know, if anyone is a startup founder right now, I'd say it's time to be excited. I think it really is a good time now, better than last year. So, you know, we can mourn about the current, you know, market climate, or we can see it as an opportunity.
Right. And also in bear market, probably most short-term, let's say, founders or the projects that aim at short-term profitability, probably they will not have the incentive to build. And then the ones that they really have a product market fit, they're really passionate about their technology, their solutions, they are going to build anyway. And then if they need fundraising, they're going to do it. So like Asim said, focus on the success, not focus on trying to time the market when to raise fund. Yeah, I really like this.
Absolutely. I think there's a lot of bad advice online around, hey, you need to raise money. Well, my first question is why? Raising money can actually make things worse, because now you have more cooks in the kitchen. Now you have people that are in your ear telling you that you need to worry about X and worry about Y and worry about Z that you never thought of before. And so sometimes raising, you just have to realize that when you raise money from someone, now you're going to end up sleeping with them. You know what I mean? you make your bed and you have to sleep in it with them, right? So now you have new interested parties who might not care so much about your unit economics. They might not care about the product market fit as much as they care about the margins, or they care about your growth trajectory in certain areas. And so it's really the way that I don't believe in luck. I only believe in probabilities. And so for me, whenever I'm talking with an entrepreneur or operator, I ask them the question, if we give you money, is it going to increase the probability of success? If so, then that's what I want to talk about. I don't want to talk about let's raise money because you think. Is it going to increase the probability of this particular success, of this particular idea in this particular market, right? It has to be very tactical and it has to be pointed and specific.
Okay. And then, okay, when it comes to how VC or how you guys think, right, how you evaluate startups, there's another question from the audience. What are the most important points in a pitch deck for the first contact? And what are some red flags for the first impression?
I can hit that very easily. The most important part of the pitch deck is not the pitch deck. The pitch deck isn't as important as the story that I want to hear, right? As a venture capitalist, now I might be overly biased here because I'm a storyteller and I'm an operator and entrepreneur myself. So I'm your usual trope. Entrepreneur, operator, had some success, became a venture capitalist. Nothing new here. But if you can't tell me a sensational and amazing and engaging story about why now, why your product, it's not going to capture my heart. I want to be involved, not just cutting you a check. I want to be part of your story. When you're winning, I want to be part of that. And so the number one thing is not to focus on what's in the deck, at least for me. What's more important is, do you have a succinct, powerful story to tell? And can you convince me that you are the right person in this moment in time for this idea that in many cases isn't that unique, right? It's not that new, but why you, Why now? Why your product? You have to be able to bring me into the story so that I can see myself as being participatory in your success. So I care less about what's in the deck, especially for early stage investments, right? If it's a Series B or Series C, I mean, you should have some pretty substantial metrics and these types of things and in trajectories. But for early stage, tell me a great story. And through your storytelling, do you actually know what you're talking about?
Right. How about Asim, some red flags that you see, or also some key points that you are looking at?
Yeah, so I'd say, yeah, I think there's enough templates out there. What's a good deck? You know, what VCs say should be in a deck. I think what we're really talking about here is how to approach a VC more than just the deck itself. And this is where I think, you know, like how not every projects don't like being compared to others, where we say, oh, are you a bit like this person? They're like, no, we're not like this. I have to differentiate myself to show you why I'm not like them. I'm a bit different. It's also worth noting that VCs are also different, whether we focus on different regions, different stage, different ticket size, different types of companies. We seek different things in founders. We have different size teams, so we source deals differently. We're based in, our approach to sourcing is different. Some have third-party capital, some run their own family office. There is no one size fits all for when it comes to approach. Most of the things that hit my inbox, as cold emails, pretty much everything gets deleted. And this is because of my approach, and it works for my firm. So, fine, we miss out on one person or some people's deal, but this is approach we take. So for me, focusing on approach more than the deck, I'd say the approach for us is we normally work through more of a referral network, or we meet you at an event. And you're at an event because you are also building your network, which also is a good sign, because you're going to need that in some shape or form, whether it's fundraising or business development. So it's the interactions at events where you physically meet people and think, you know what, because this is about the storytelling stuff which Peter said. And for me, no one can approach me in an email and give me enough confidence that, this is a credible person. And it's all about credibility. So referrals through my VC network, where someone else is validating you to some extent, enough for you to be put in front of me, so I can then as a VC have to, validate myself, or meet you at an event and I speak to you and I feel there's that, that deepness in the conversation from a technical perspective, that, okay, I like what you're doing. I like how you talk about things, how you approach things. You can tell very quickly. I can usually tell when I'm meeting someone at a network event, in the first 5 minutes, if I can still be speaking to this person an hour from now and still be engaged, or if that 5 minutes is the end, and I'm likely to be speaking to somebody else after that. And I think you just cannot recreate that in a cold email approach. And I know this means it's not an easy way to approach. It's not easy to approach VCs, and this is why you really have to be raising 6 months before you're actually raising. It's because you should really be even maybe 12 months before, at least building out that network, speaking to people about your idea, testing it, perfecting the pitch through the questions people ask you in person, building the networks, having a few people who validate you or vouch for what you're building. And I think that's when we would like to be approached. And then when you talk about red flags, when you can say, when we have people reaching us in that way, there doesn't tend to be too many red flags, because I think they've honed their messaging. They've been, people have given them some credibility already, and you could say we've filtered to some extent. But they could be. I think when things are said and not explained, that's always a bit of a red flag, because I think there's got to be enough of a understanding in terms of who you're speaking to and what you need to be explaining to an investor at the point of sharing information. And beyond that, if we went into any other red flags, we'd be going into very specifics, and there's lots of different types of projects but you know, normally red flags come up during DD rather than first approach for me. I think that's probably a better way to think of it. And then, you know, the types of red flags that can come up during, it could be anything really. There's many aspects which we focus on and we score during the process.
Sounds like a dating experience.
It's not wrong. And we had a question in the Q&A from Jens who says, can you recommend 3 to 5 networking events to get in contact with private equity and venture capital investors, especially on an international scale? And Asim basically went into that. You have to get out there and you have to practice your communication of your idea. I always tell startup entrepreneurs, especially early stage, is that your first product is not the product you think you're building. Your first product is your story. Can you tell me a good story? And in many cases, and I'm sure Asim can tell you, it has hundreds of these examples of where you've talked with an operator or entrepreneur and the idea is great, but they're really crappy at communicating it. It's like, bro, I get your idea. What a great idea, but you're just really shitty at communicating this right now. And you need to get better. And so you need to iterate through your narrative. You have to iterate through the questions that you get and learn how to communicate it more effectively. And so in the beginning, especially early stage, your first product is your selling of your story. It's a selling of your narrative. It's a selling of the idea. And in many cases, I use the word speed dating here. In many ways, you're selling yourself. I agree 100% with Asim here. Like when I'm sitting down with operators, I could, if I feel like after 5 minutes, there's no way that I would enjoy talking with this guy for another hour and a half, it ain't going to go nowhere. Right. And so you really have to work on the relational aspect of your communication. You have to work on the aesthetic nuances, the details, the specificity of your narrative and your story. And you're really going to have to be able to learn how to unpack some of those ideas that you get questions around so that you can give a full package to an individual or an investor to say, this is the story. I am the operator. This is the idea. This is why now. This is why it's important. And this is why I need you and your money to participate with me and building out this dream. And so when I hear all of that in a really succinct and concise way, that's where I get more engaged.
Right.
On the event side, Yasi, just to quickly add on the event side, just, you know, there's a lot of free events, lots of blockchain meetups. If you're talking specifically about blockchain, there's free ones, and then there's the big conferences that happen globally. You know, whether you're talking the consensus, the you know, the Ethereum do like ETH Denver's next week. There's lots of these things. I think there was one in Barcelona last week in March. There's Paris Blockchain Week. You know, some are expensive, some are not. If some are expensive and you're in that city, there's lots of side events. Many are free. When you add these events, you know, just give it a bit more you know, how you can actually network at the events. I think this could be useful as well. I think it's worth noting that, you know, always going straight to the VC thinking it's a case of, you know, going from A to B is the easiest way to operate and being that direct. I can tell you at these events, sometimes investors hang around with other investors because, you know, we don't want to queue basically of people pitching to us. It's not, you know, we're not robots either, and nor does it give you the respect and time you deserve as well. It's not always the A to B approach doesn't always work. Sometimes you have to go through a few of the channels. You could be speaking to somebody at you know, a desk for Coinbase or, you know, a desk for Binance, and you could be talking to this person. Maybe they are someone who could you know, use your product. Maybe you're building some kind of tool which does some kind of surveillance and they might want to use it. You start speaking to these people, and if you're speaking to someone who's at a bit of an established business, through them you could become the referral to a VC. So thinking, oh, I have to go to these networks, I need to go to this network to meet a VC. And this is why you need to start 12 months or 6 months before, because that shouldn't be the goal that I'm going to make a VC friend and he's going to either do me a favor or by the end understand me. You need to be meeting people. People need to be understanding you, you know, potential clients. and people will become your referrals, and you become part of that community. And then, that expands into Telegram chats and all sorts of different things, which I'm sure Peter knows about, where there's lots of private groups, which, startups don't tend to get into, but certain founders will in the future. And, they can also share deals with VCs. And there's a lot of ways that VCs work without the noise. And that noise, you're just adding to noise at an event. If you just came and expected to have someone listen to your, VCs don't go there for speed dating with startups, you could say. So this, I hope this gives some value in terms of understanding how the longer games played and how the networking is done, rather than thinking of it as a very linear.
Yeah, I think I'm going to add to that. Like cutting a check to an entrepreneur or operator is a relational consideration, at least for me. And I can already tell for Asim as well, that there is a relational aspect to the cutting of a check, and it takes time to build any type of substantial relationship. For me, one of the most exciting things that I receive is an email months later after someone has connected with me and I said, "No thanks, sir," or "No thanks, ma'am." And 9 months later, they shoot me another email and they're like, "Bro, I went underground. I built this thing. Let me show you what I've done and how I've improved it." Though, for me, that is one of the best ways of continuing the relationship with me, is not by pinging me and adding to, as it seems said here, adding to the static, because we get inbound like crazy all the time. I get easily 15 to 20 emails, DMs, or some type of inbound per day. I get a lot of it through Twitter and Telegram and those trashy platforms. But I get so much inbound that it's just, my natural response is no, I don't know you. Who are you? What is this? What is this, shitcoin Shiba Inu thing that you're, sending to me? Like, I don't want to invest in another dog coin, right? I don't have a relational equity with you. I don't know who you are. And so, there needs to be proof in the pudding, beyond just engaging with us and telling us about your idea. Continue to seek us out for sure, but you have to be relational in it. You can't be transactional, because if you be, at least for me, if you come at me with a transaction, it's like, "Hey, Peter, I need your money and this is why." It's like, well, I don't know who you are. So you need to have the relational aspect as part of it as well.
I think this is a very, very precious point, because many people think, "Oh, do you know some VC? Can I get an email?" And I even get phone calls, from some companies, and ask me to refer them to the VCs I know. And I was like, "No, I'm not going to do that." So it's very important for startups to know that you need to build the networks and the trust first before pitching anything, before asking for money. So this is very important. Yeah, like Asim said,
Point,
it's not
Yasi. I
so
think,
much about the pitch deck, it's
yeah, I
more
think
about the approach.
I was just gonna say, Yasi, that's a good point. Like, I can just say, like, if Yasi ever shares something with me, because we know each other, we've known each other for a few years, I'd have a look specifically because of who it came through. So Yasi, you can be my filter from now on. So everybody, you can ping her instead of me.
Hey,
No, but there are some people I don't even know them. They just call me or they ping me.
that's what
I'm not going to do that.
But that's what Asim is asking. Asim is
you
asking
could,
for you to take the time to get to know them so that he doesn't have to, and neither do I. So I love that idea, Asim. Yasi, you are going to spend the time building relationships, and then you tell us which ones you like. I like this.
Yeah.
Yeah, I'm going to be your pipeline filter. We have one more question here. We have a couple more questions here. Then we are going to the end of the session. Is from Sina? What is expected from a pre-seed, seed round, and Web3 companies to raise? Because she's asking, is revenue necessary at this stage? Because in order to build ambitious protocol without raising, it's very difficult, right? So what traction is needed? Please give some practical advice.
So I'm gonna respond to this quickly, and my response is not going to be super, let's just say, super encouraging, but for me, it's a reality. We now live in a interconnected, decentralized world where there is a multiplicity of communities who love what you are building. Trust me, what you are building is not new. What you are building is most likely a permutation or an unbundling or rebundling of something that's already in existence. Let's be intellectually honest. And so because of this reality that what you're building is not necessarily novel and new, it's a permutation or it's a piece of something that's already in existence, there's already individuals who love what you're doing. You need to find those people. Sometimes those people are exceptional engineers. Guess what? If you're going to be building something that's an ambitious protocol, plug into that community. Find ambitious engineers, very capable engineers, convince them to do sweat equity, work on your project, your program, if you're not an engineer or developer, coder, so that you can start building out the MVP, building out the infrastructural runway, building out the idea with someone who's passionate about it already. And so I might sound a little terse when I say this, but we now live in an interconnected world where you actually don't need funding to begin work on it. You need to just find a passionate engineer that is willing to obviously with equity, to be able to begin building your idea with you. This is not hard stuff. And when operators come to me and say, Peter, I can't find any engineers, I'm like, well, then you haven't looked, sweetie. You haven't looked, bro. You haven't looked hard enough. Like, great operators, great entrepreneurs are never without resources. They just have to be resourceful. And so there's everything that you want to build out there already is in existence. Let me go even farther. There are operators, entrepreneurs who are building what you want to build. They're not smarter than you. They're not more sophisticated than you. You know what they are? They're just more resourceful than you, and they started earlier. And so frankly, I find it to be a weak excuse when people say, hey, I got this great idea, I need funding to get started. No, you don't. You need to be resourceful. You need to network. You need to find people that can come beside you, maybe become a co-founder, and you say, hey, look, I got this idea. You like this idea. Let's put our heads down. Let's start building it out. Let's start building out a wireframe or low fidelity wireframes, or even an infrastructure, or even a small light MVP or an alpha. This is all possible, but it requires you as the operator, entrepreneur, to do the heavy lifting and to do the hard work to find these people.
Yeah, I would just add that, and I think it's probably just rephrasing. Sorry, I put my hand up for some reason. So probably just rephrasing a lot of what Peter's saying, but best tech doesn't always win as well. You need to be resourceful to basically get the business out there, to get the tech out there. So it's a challenge. You got to sweat as an entrepreneur. If it is 100% necessary for you to get that funding, that's a challenge. If you've got nothing to show and you need a lot of funding, like a lot of layer ones do. If you think about the successful layer ones, the ones that have attracted the most money at the outset, the profiles of those people, I'm sure there's someone out there with a much lower profile who could possibly have a new approach to a consensus mechanism, which hasn't been done before, which is completely novel. But it's not, it's not been successful because it hasn't got the funding like these high profile people have managed to raise. But, business is about success. It's not about just having the best tech. You're building the best tech for the success, but you're building it ultimately for success. So, it really is a case of you need to be resourceful and find a way. And yeah, I think this also links into getting some early believers, networking early, explain to people why what you're building should be something they should back. It's not just another layer one, another DeFi protocol trying to attract liquidity. So yeah, there's no straightforward answer, and I'm sure, but even when you asked it, you knew it. But I hope there's some insight in there that it is a struggle, and that's what it is to be an entrepreneur. You have to be resourceful and find a way. Because if you don't, then there's lots of tech that must have died, which never reached our desk because they couldn't find a way. And it's also, I would also say, I don't want to put VC at the center of the universe. There's a lot of stuff that doesn't need to reach our desk to be successful. You don't even sometimes need funding, and it's just a case of finding the right thing when we're not always the answer. And yes, we miss out. I'd love to be involved in something successful, which I haven't been. But if you don't always need us, then don't make your life more complicated than it needs to be.
Okay, thank you so much. Great answer. If it was so easy, if everybody can get funding and to build a project, then everybody can be successful, right? Everybody can be a great entrepreneur. Because it's not easy, that's why only few made it. So I have two last questions, then we close the session for tonight. We have a lot of questions, so thank you so much for the audience. Also, thank you so much, Peter and Asim, for the great answers. So what are the current thoughts on games in Web3?
I used to play video games, and then I grew up. No, just kidding. It's okay to play video games in your 40s and 50s. But video games are going to be huge in Web3. I absolutely believe that the tokenization, as well as the economies that have been proven out already over the last 2 decades in gaming, is only going to continue to grow. Now, what do I mean when I say that? Well, we see, for example, in World of Warcraft, or Diablo, or Fortnite, we see hundreds of millions of dollars in economies and marketplaces that are in these games alone. Now, the gold that you can get in Warcraft and the V-Bucks that you can get in Fortnite aren't tokenized just yet, but they will be. And so in terms of games for Web3, it's going to be a huge arena. It's not a place that we play. So other than that, we don't invest in Web3 gaming. I'll let Asim take a shot at that.
Same. As much as I used to enjoy, and I hope I can start enjoying again when I have more time, I do enjoy games. It's not something which we can judge. And all of a sudden, just because we've been a blockchain VC since 2018, if gaming took off this year, it doesn't mean all of a sudden we can reskill ourselves and start investing in games on behalf of our investors. It just doesn't make any sense for us. Now, we know there's a lot of gaming funds and people who focus on gaming in their funds. And if someone's creating gaming infrastructure like NFT infrastructure or DeFi infrastructure, something like that could be of interest to us. But a game itself, I cannot judge. The big winners and losers within the gaming industry is something I think it's still very early to determine. I think we've seen a massive boom in NFTs, and certain things which did well probably will get washed out and never do well again, and maybe only the high quality art will exist and a few other pieces. I think similarly with all the concepts around gaming, no one's ever paid me to play a game before. Maybe I'm just not good enough, but for me to all of a sudden start to be paid because we've tokenized the world, it's still a concept I don't fully get. I think there needs to be some economic value, some serious understanding of where the revenue, where the money will flow in before it flows out to someone like me for playing a game. So I think things need to be understood. I think there will be a lot of testing, and I think it's up to entrepreneurs to be to do the experiments and to come up with the wild ideas. But as a VC, we don't have a firm view on what the winners and losers in that space will be right now. And specific games is something which we, just like Peter, do not consider.
Okay. So that concludes all the questions for this session. And thank you so much, Peter and Asim, for being here, sharing those valuable insights. We also consider this as an online mini conference. So is there a way our audience can get in touch with you, start to build a relationship with you guys?
Yep, very simply, you can find me on Twitter at AgilePeter. I'm not hard to find online.
For me, I'd say a couple of my team members are in East Denver, so I'm throwing them under the bus. So go ahead and they'll be going there next week. I'll be in Dubai as well. I eat Dubai, and otherwise you'll see me at some conferences. I think that's the best way. If you find a way to get hold of my email, and then you meet me in person after, just don't be insulted if I hadn't responded to you, because it's just like Pete said, it's going to be stuck in a pile. So I think, it's like I mentioned, for me, and every VC is different. For me, it's all about referrals. I think a direct message is just too much noise. And I apologize in advance if anyone tries, because it's just something which is, as a, you know, I'm not a robot. It's just impossible for me to give you the time and respect your message deserves.
Okay. They have to catch you in person. Like I think
Yes.
we met at least 3-4 times in different countries
We
and
met in
different
person.
conferences.
That's how I remember when we met. It was pre-COVID, 2 or 3 conferences like in a row. It wasn't like we met over the internet or in any way, was it? So even though the space was smaller, it was probably easier to do it back then. But even then, yeah, that's if you want something meaningful and important, then you know you have to leave your house and start attending, put a bit of time and money into this.
Yeah. All right. Then yeah, you guys can try to catch Asim in different conferences. Peter will be at Agile Peter on Twitter. Also, you can catch Peter in different places. I guess
I'll be speaking at 5 conferences this year. I already spoke at one in January. So I'll be at Bitcoin Miami. I'll be at Mining Disrupt. There's a Switzerland conference I'm supposed to be at, and a Germany conference I'm supposed to be at as well. So the best way to find me is online at Agile Peter on Twitter. You can find out where I'll be speaking at.
Okay, thank you so much. And also our audience share their gratitudes towards you guys. Thank you so much. And for all the startup group, working group members, stay tuned. We'll have more upcoming events for you guys planned in this year, and join our Telegram group. And in any case, if you have any questions, feel free to reach out to me or to Crypto Value Association, to Nikki and all these guys who is organizing the backgrounds. So have a nice evening, morning, wherever you're located, and let's stay connected. Bye-bye.
Thank you. Bye-bye.
Thank you.